One of the problems with recruiting for investment banking is not the knowledge or skills you acquire, but the access to talk with real investment bankers to put your best foot forward. Our sponsor, WSO Academy, can provide those connections with 60 head mentors who are finance professionals at top firms like Goldman, Centerview, and JP Morgan. Imagine being able to get on the phone within 24 hours with one of the Academy's 1,300 mentors right before a critical interview. Get on the waitlist for WSO Academy today by clicking the link in the show notes or by visiting wallstreetoasis.com/academy. All right. Welcome to Investment Banking Insights. This is the one, the only show teaching you both the technical and non-technical aspects of investment banking. I just want to see how that sounded. You let me know what you think. Hi, my name is Alex Mason, and I am your host. And I am just really grateful that you're here listening to me, learning this investment banking stuff alongside with me. And we've been going through a lot of concepts where just running through the accounting right now, just learning it, soaking it all up. And it's going to make us smarter. It's going to make us better. It's going to make us more effective. And so I appreciate you taking the time to be with me. Today's question is related to write-downs. What happens with a write-down of $100 of assets? So we have some asset and we're writing it down. Okay, so this is similar to a prior episode where we talked a little bit about a company buying a factory and writing down the value from $100 to zero. But now let's look at it in isolation. Sometimes businesses buy assets that become worthless over time, or maybe they were worthless all along, but company management finally decides to own up to it and record it on the books. Either way, this is called a write-down. And it's actually really common in corporate America where assets that were valued at a certain amount are now valued at a lower amount. So what happens to the financial statements? Well, if we take our structured approach and we start with the income statement, let's take a look. The $100 on the income statement is recorded as an additional expense. And so that lowers our pre-tax income by $100. Now, if the tax rate is 40%, then net income is reduced by $60. Relatively simple. Moving on to the cash flow statement, we got our negative $60 at the top is where we're starting from with operating cash flow. Now, when assets are written down, and this is a key point I want you to remember, when assets are written down, it's a non-cash expense, which means that we have to add it back to the cash flow statement. So we add back that $100 here in this section. So we have negative $60 plus $100 equals positive $40. So positive $40 in the operating cash flow statement section. And it makes sense that cash flows increase with a write-down because the company is recognizing a loss. And so remember, as we saw in the income statement, there's a tax savings associated with that. And that tax savings translates into additional cash for the company. Very important point. And then in the investing cash flow section, there are no changes. In the financing cash flow section, there are no changes. Now, taking it over to the balance sheets. Remember, our cash flow went up by $40. So the cash line item on the balance sheet goes up by $40. And the assets that were written down are now devalued, right? We're writing down $100 worth of value of assets. So that goes down by $100. So the total change in the assets section of our balance sheet is plus $40 minus $100 equals negative $60. We had the plus 40 from the cash flow increasing, the negative 100 from the write down of the asset itself, and that results in negative $60. Now, looking at the liability side, there are no changes to liabilities here just because of the write down. And then shareholders' equity, remember, we got to bring over that net income. So net income, remember, from the income statement was reduced by $60. So that impacts shareholders' equity by negative $60. And then what do you have? You have a balance in your balance sheet because your shareholders' equity went down by $60 and your assets side went down by $60. So your balance sheet balances, and there you have it. So that's what happens with a write down of $100 of assets with regards to the three financial statements. Now, we already kind of covered this scenario a little bit, but we're bringing it back in the standalone scenario with this episode. What I am going to cover next with you in the next episode is what happens with a write down of $100 of debt, flipping it on you. So let's go ahead and talk about that next. But for now, this has been Investment Banking Insights. My name is Alex Mason, your host, and I'll see you on the next one.